Good morning and welcome everyone to episode 14 of Mortgage News Live, coming to you from Muddy Road Recording Studios in the beautiful but very rainy Blackdown Hills near Taunton. Thank you as always to our sponsors MPowered, the Intermediary and of course Newspage for their support. We have another packed show this morning where we'll be talking about a wealth of topics but concentrating on low deposit mortgages as a main course. In the news this week, we are back into the maelstrom of lenders increasing their mortgage rates in a whirlwind of activity that leaves brokers gasping for breath once more. NatWest, Santander and Nationwide are amongst the biggest lenders to hike their fixed rate offerings. Swap rates have continued to stay high, with 5-year money sticking at over 4.1%, with no real sight of anything changing anytime soon. We really do need some positive inflation news. Hopefully, the sooner the better. But as it stands, the predictions now are for no cut until maybe September, and then maybe only one this year. We've seen some interesting criteria changes from lenders to try to help where rates can't. For example, Halifax increasing the maximum LTV on their interest-only part repayment mortgages. And Michael Gove in politics says he cannot guarantee no fault evictions will be banned in England by the next general election, as landlord and tenant groups argue over the Renters Reform Bill, which is being debated in the House of Commons. But enough of my raucous vocals, and over to this week's financially literate panel of experts who will be discussing the industry as a whole and the lesser spotted 99% mortgage. Joining us are Ava Bajeska from Truly Independent Online. Welcome.
Thank you.
Jeremy Duncombe, who's the MD of Accord Mortgages. Welcome, Jeremy.
Hi, Monty.
Lee Karasavas from Prolific Mortgages. Welcome, Lee.
Hello. It's mine.
Rohit Kohli from The Mortgage Stop. Welcome, Rohit. Welcome back.
Thank you.
And Nikki Gauntlet from Plus Financial. There's a lot of you here today, so we will try and get through this as smoothly as possible. But first of all, I wanted to look at swap rates, because we're all swap rates experts now, and none more so than young Lee. So we're honoured to have you here, Lee. The current state of rate withdrawals, and Lee, all jokes aside, you're like all of us, really. We have become swap rate experts, and your updates are really, really good. If you haven't seen them, check them out on LinkedIn. How are you reading this, and what's the general feeling from your clients? Is there more confusion than ever now?
Yeah, thanks for that intro, Monty. It's very nice of you, mate. I have become a little bit obsessed with swap rates over the last few months, that's for sure. But yeah, we've seen quite an uplift, quite a trend that's not really what we're expecting, to be honest. We've seen the swaps edge up quite a bit, probably for the last couple of months. And looking at it this morning, 5-year money still at 4.132. 1 year, as you rightly say, now at 4.928. So kind of suggesting only the one cut this year rather than two when you look at the 12-month period. But for me, the swaps have always been a clear indication of a bit of direction for travel as to where rates are going to go over the coming weeks from lenders and when they price. So looking at these go up, up and up kind of really only suggests what we've seen over the last few weeks, which is rates are going to go up, up and up. And it also suggests that we're going to see rate pulls quicker and quicker and quicker. So the snowball effect there is as these rates start to get pulled, swap rates go up, rates start to get pulled because the margins are getting squeezed. Levels of serviceable lenders will start creaking because applications getting flooded into the lenders. So yeah, I'm sure I'm not the only broker sitting in here that has had a few long nights over the last few weeks. Rate pulls, especially over the last couple of days, rate pulls at 10 o'clock in the evening, trying to get applications go through. So yeah, other than the really hot office I'm in at the moment, which is making me lose a few pounds, the anguish and the sweat from the industry has made me lose a few pounds as well. So it's, yeah, I'm coming in about half a stone lighter than I was 2 weeks ago, to be honest.
Well, yeah, there you go. Every cloudly.
That's it.
Ava, what about for you and your clients? Because you're in Carlisle, is that right? So
I am, yes, yeah. I mean, I do deal with clients nationwide as well, similar to Nikki. So yeah, we've seen all sorts. Of course, the bigger mortgages are impacted, I feel, more because even a small difference in interest rates can make quite a significant impact on the monthly basis. So I do feel that there's probably going to be a bit more panic again created in the market, especially if the headlines do not help. Anytime there's a rate increase, it gets shouted about, so people do end up panicking about it. I feel the fact that we do get notified by lenders we don't get much notice, but at least we get some. It allows us to prepare our clients to say, listen, that lender is going to be increasing rates, let's say tomorrow. We need to get the application submitted in tonight if you do want to secure that rate. Alternatively, you are going to be looking at a slightly higher monthly payment. It's navigating that. And ultimately, I think it's setting expectations more than anything and just helping people understand that rates are volatile right now. So what I'm quoting you right now, we may not be able to secure that.
And Rohit, are you finding that really quick speed is still causing you issues?
Yeah, it is. It is at the moment. So we've spent the last few weeks telling clients that if you're happy with this mortgage, then we should push the button on it now. Let's not dilly-dally, because rates are changing rapidly. And I think where clients aren't taking that advice, they are kind of regretting it now. And they're seeing that the rates that they were hoping, downward trend that they were expecting to happen is not happening. I think the good news from the start of the year and the expectation from the start of the year have kind of probably falsely offered some clients the view that if I hang fire now, I'm going to get a better deal in a few months' time. And I think it's coming, no other way of saying it, slapped them in the face. And weren't expecting this increase they're seeing. So, it's needing some stressful evenings at the moment.
Yeah. So I'll come to you in a sec, Jeremy, just from a lender perspective. And Nikki, how do you deal with that with your clients, where clients might have waited for a little bit and actually, instead of rates going down, they've actually seen them go up?
Yeah, I think we're definitely seeing a bit of a contrast to the beginning of the year. I think as brokers, we've just adapted the way we work with clients now. I think given the last couple of years, we've seen so many changes and realised we just can't predict the directions. It's very media-led, isn't it? So as soon as something's on the news, people do react and jump to that. So I think, like everyone else has said, it's just expectations with clients, and just being realistic and honest with them, and also not trying to second guess what we think we're going to do, because I think there was lots of talks about rates coming down this year, and I'm still getting people saying that, but then we're seeing lenders increasing rates. So I think there's just managing expectations for me is key, and just keeping in contact with the clients as well. It's relative to them. It's individual circumstances every time, isn't it? And it depends where they're going and what their thoughts are in the future, really.
So Jeremy, as in, you're literally on my screen, you're literally surrounded by a wall of brokers. So you have everyone on you. But from your perspective, actually, it's difficult, isn't it? Because I've also seen and brokers, we can get carried away actually that it's all about us all the time. But actually, lenders are finding this period tricky too, aren't they? We've seen some lenders, their profits have been hit a little bit. So how do you deal in this strange swap rate environment as well?
Yeah, I mean, we're reacting. Lenders are reacting like everybody is to what's happening. I think there is some context and some difference this time, though, to what we've seen before. I think nobody's expecting base rates to go up. So I think we have a natural ceiling, which is really important. So what we're seeing now is that the speed of reduction of rates is the thing that's in question, not the fact that rates will be coming down. So base rate, with every forecast I've seen, will come down. Nobody's forecasting base rate will go up, which means there's this natural ceiling on where swaps can get to. Lee said there about 1 year being at 4.9. So that still suggests in the next 12 months that base rate will come down. And all the forecasts we're seeing is that will come down one time this year. So, there is that, but all that's already been priced in the swap rates for this year. So there is a natural ceiling. What we're seeing is that where originally beginning of the year, we were forecasting maybe 5 or 6 base rate drops, there's now only 1. So rates will just come down slower, and therefore swaps need to react to that. So the 2-year swaps, 5-year swaps will still forecast that base rate will drop. Therefore, it's very likely that rates will drop at some point on fixed rates. However, in the short term, we're reacting to one base rate change instead of potentially 5 or 6. So that means we have to react as lenders. Margin is really quite tight at the moment. If you look across the lender market, and that's what we're all playing with at the moment. There is a finite margin, and the other thing quite interesting that's affecting that margin is the amount of churn that is currently happening in the wider market. And so
that's a really interesting point.
What we
go on, expand on that.
Yeah. So
sorry, there's a bit of a delay here.
It's Taunton. It's so far away from us all.
I know. Sorry, I'll shut up. I'll let you speak.
Satellite delay. So what we're saying is that as rates were coming down quite quickly, in effect, people were securing rates, or lenders were having to hedge swap rates based on what it would cost us to secure that money. We may secure that rate at a margin of, I don't know, let's say 80 basis points. If that mortgage churns, whether that's a product transfer or a front book product, that might churn at 30 or 40 basis points cheaper than the one we originally went out for. So in mortgage charter, the customer gets the lower rate. If we've secured that at 80 basis points and it completes at 40, there is a difficulty knowing exactly what your margin is going to be on completion. So that is a factor as well that we all need to consider as rates start to drop again. How much of that will affect lender margins? So there's other things at play here, and it's not just about inflation in terms of swap rates. We're also seeing some really interesting data come out of the US, which is performing really strongly, which is keeping swap rates higher as well. So there's lots going on. It's not just where we think base rate's going to be in the future.
Jeremy, can I just ask on that? Do you think you'll see more lenders come in line with what Nationwide have done and squeeze that option to secure a product transfer from 6 months down to a smaller margin because of that, to like 3 months or 4 months?
Well, we've always been at 3. So I think the interesting thing for us, we've seen people move out to 4, 5, 6, and then come back again. Yeah. And this is part of it. It's that almost careful what you wish for in the market. When rates are going one way, everybody wants a 6-month window. When rates are going the other way, they want a 3-month window because of the huge amount of extra work, particularly from a broker point of view, that where you may have to re-advise 5, 6, 7 times. If that window is shorter, then obviously that means you have to re-advise less times if rates are coming down quite quickly.
I think from a broker perspective, we're more appeased to the shorter terms now than we were the longer ones.
I think that's a really interesting question.
Exactly that.
That's a really interesting question, Lee, and I know a lot of lenders are discussing this. And from a broker perspective, I think most brokers now, not all, but most would probably prefer a bit of a return to where it was before.
Never thought to say that, did you?
Charter came in. No, because the idea is good in that it's there to try and help clients, but actually what we're seeing now in this market is actually it probably isn't helping the clients longer term. It's actually making things a little bit more difficult because it's making lenders, it's harder for them to price. So maybe they're pricing a little bit higher than they would have done otherwise.
Well, my challenge to that one would be, my challenge to that would be that it's to the lenders, it's not beyond the realms of possibility why if you are reducing a like-for-like product for a client, so it's the same LTV, all that's happening is the rate is changing, it's reducing. Systems can track that reduction and automatically put the client onto that lower product without having to do a whole load of new, without brokers having to get involved. It should be feasible in this day of technology and AI and all that kind of stuff. And, so we should be looking at ways, and lenders should be looking at ways how they can make it easier for clients to get the right value for their product with them rather than expecting it to go back through the whole process again with brokers.
And I think there's a financial challenge on what we would have to charge, and that's interesting. So that comes in, the customer ends up paying for that in the long term as well. So it's a really big, complex conversation. We've probably not got time today to cover, but there's some really interesting points there that say this has to be priced in somewhere.
Yeah, and our proc fee probably, Jeremy.
Lee, I said we weren't going to mention properties.
Sorry,
We've done
bad.
We've done that to death. To be fair, so let's. I think 5 against 1 isn't fair on this one.
No, to be fair, they're very good at a call. It wasn't at them.
Yeah, true. They are good. So on the whole sort of innovation piece, actually, Jeremy, is regulation stifling some of the innovation that lenders can do? Actually, is the current regulatory environment impacting innovation with Accord in terms of developing new products or services? Is that something that you found? I know you've come out with a 99%, which we'll come on to.
Yeah, it's a bit of a balance, really. I think regulation has been there for absolutely the right reasons. So as we went right back to the credit crunch, the rules that were brought in that stopped lenders doing silly things were really prudent. We had to have those rules in. The changes that were made were the right things to have. And actually, there have been changes to regulation which have been positive, where we had the stress test at 3% above the revert rate. That's now back at 1% above the revert rate. So that there are checks and balances in place which are sensible, that lenders shouldn't be trying to push past. But there are restrictions, and particularly how much capital has to be deployed against the high loan to value sectors. That's an area that is quite restrictive. We have limits as to how much we can lend as lenders at certain loan to values, and the amount of cash we have to put aside to mitigate that is significant. So I think there's still more that can be done. With the absence of that, we have to then look at innovation ourselves and what we can do that's in our control. And that's why things like the 5K deposit mortgage was something that was in our control. And I think lenders are starting to look at what they can do on affordability, where they can make tweaks to current criteria, and where they can maybe test risk areas without increasing arrears or anything like that. The last thing we want to do is to go back to a position where clients are in financial distress or difficulty. And I think what the last 10, 15 years has proved is that arrears are still actually really, really low now. And that's down to a lot of the prudent decisions that were made 6, 7, 8, 9, 10 years ago. We've got a really healthy mortgage book now. We shouldn't walk past that.
Yeah, and that's even in the face of higher interest rates over the last 18 months or so, isn't it? So that's still positive. So is that a bit of a message from you to government and regulators that actually one way of helping first-time buyers is actually ease the capital restrictions on lenders at higher LTVs?
Yeah, I think there's a few things like that can be looked at. Stress rates in an environment the way rates are coming down. We are still stressing at a revert rate which is 7-8% with a lot of lenders. There are very few people forecasting rates will need to be ever at 7 or 8%. So can we have a little bit more flexibility in some of those stress rates still in a rate environment where rates are likely to come down? We sort of feel that 6 is pretty much the roof of where we're going to get to. So can we have a bit more flexibility on that? But I'd say underline those rules are in the place for the right reasons. We've just got to find a way to make sure they're still valid today.
So 5K deposit mortgage, 99%. We've also seen a track record, 100% mortgage. Nikki, is that when you first saw these types of products coming out, and especially the 5K deposit from Accord, what were your first thoughts? Did you think this is great? There's a demand for this. Were you worried about some of the how you're going to educate people around on the risks? What was your thought in your area?
Yeah, I think for me, any scheme, any incentive, any new proposition that's brought forward, there's always going to be a client or a market for it. I think these sort of things definitely create big headlines, which effectively gets people interested again. And this is exactly what we need, I think, for the economy. We need people buying. Albeit, on the face of it, it is great. Whether the amount of people that will actually go forward with it, I think is another conversation. But I definitely welcome any kind of incentive, because there will always be a set of clients that will benefit from this that would not have been able to get on the ladder. And I think it's really important that we get people buy-in, in particular first-time buyers. I think these sort of schemes are great, not for everyone, but equally I think this is where you need a broker more than ever. I think advice is everything here. It's not for everybody, so it's not particularly something that I think people can just jump on Google and do themselves. I think it emphasizes even more that you need to speak to a broker and get some good advice here. I think that's definitely a positive for me.
Yeah, I think we'd all agree with that. Ava, is that same for you? You positive about these types of products?
Yeah, I agree with Nikki. It's definitely not for everyone, but it's good to have the choice, so that if we do find a client who, that's essentially the only option, it's either this or not being able to get onto the property ladder at this stage, they then have that choice and they can say, well, actually, yeah, we are prepared to pay that little bit extra to be able to buy a house this year, or, well, actually, we're going to wait another year and save for a higher deposit, rather than just it being a straight up, no, you can't do it. At this point, you're going to have to wait regardless. So it's definitely good to see that sort of innovation. Of course, when it first came out, my alarm bells went off. Negative equity, especially with obviously what property prices are doing nowadays. They're up and down a bit like rates, depending on the area that is. So obviously in my area, in Carlisle specifically, the property prices here aren't as strong as they would be down south. Whilst there's still a lot of demand up here, a lot of people are still getting them under asking price. So from that perspective, negative equity is something that we have to be very, very careful about. So the fact the 5K deposit mortgage is only available on a 5-year fix definitely helps with that. And that's my first kind of point of call with people. If you want to go for a higher loan to value, we're going to have to focus more on the longer term fixed rates at this stage. So it's weighing up the benefits of that and whether people want to fix in at what is perceived to be the higher rates right now for a bit longer.
Rohit, before I bring Jeremy in, is it much the same for you or any counter view?
No, it is. I mean, I had mixed views about it when they first came out, but we've since spoken to a number of clients, and we focused very much on long term with this type of product for the clients. Where do they see their circumstances in the next 5-10 years? Because if they don't see their income growing and if they can't build capital in the property, then they are at risk of negative equity. And then we talk about house prices when they see house prices in the area that they're talking about. And then we talk about, their family circumstances. If I've got a young couple thinking about this, we talk to them genuinely about if they're planning to start a family, because that will change their ability to pay that mortgage. And something at this kind of LTV, we have to have that long-term conversation with clients. And what we find is when we do that, it often really does kind of sink in as to the risks that they're taking with this type of product. But then we've got other clients that actually this is perfect for. And they are on a career path that will allow them to build equity in the property in the future, and it's something that works for them.
Yeah, I've always been a massive fan of any kind of innovation, actually, and I think, and that's why all you guys around you're all excellent advisors, and you can help direct people towards the suitable products and the non-suitable products. But having products like this, Jeremy, in our armory is something that is welcomed. Have you seen an influx of stuff on it, and how's it going early doors?
Yeah, I mean, we've been really pleased with how it's landed, and I think just the summary on the call this morning, I mean, that's great. People understand the product. It's not for everybody. It's for a specific group of people who have got a good credit score, do have good incomes, but are probably renting and are paying a lot of money out, which is at the moment is wasted. So it helps them get on the housing ladder. It helps them with future house price inflation because it's starting. Our research showed that instead of maybe having to save up for about 7 years, they can now save up for about 2.5 years. So that getting on the housing ladder, you can't fix everything. With our research showed that deposit was one of the big areas for customers who didn't have bank of mum and dad, bank of grandma and granddad. So it's a very specific group of people, and they have to be, because of prudent lending rules, they have to be able to pass a high credit score. But people are, if they pass our 95% score, chances are they'll pass this. We've seen some fantastic stories of people who've managed to get on the housing ladder where they didn't think they would be able to. They can afford it because they pass a stringent affordability criteria, and the negative equity we've thought about because of exactly what you said, Ava, the 5-year fixed rate, and also the fact it's on capital and repayment. So all of our modelling showed that at the end of those 5 years, we know they can afford the payments. Their negative equity wouldn't be there because they'll have paid down the debt, and hopefully there'll be house price inflation. So yeah, I think those sort of innovations are really strong. As I say, it's not for everybody, but we are seeing some really strong demand, applications and offers having come through, and it's performing better than we expected it to in terms of the number of people who've passed and have now got offers through. So yeah, very, very pleased with how it's landed, and I think it's landed well in the broker world as well. It's a simple product. People have understood it. You need 5k, you need to pass a credit score, you need to have good affordability, but that's it really. It is a simple product, and that, I think that's what's landed really well too.
Yeah, we like simple in the broker world. We are people very simplistic, like me. Lee, what's interesting in this actually? Sometimes some of the negative stuff when you see something like this released, and whether it's on Twitter or X or some of the press response. Do you think some of it is really unfair? They either look at it and go, well, this isn't going to change the housing market, and as if it was ever expected to, or this is just going to cause loads of trouble for people, and it's wrong. How do you counter all those negative voices?
Yeah, I'm with you. I think any kind of innovation has to be a positive thing. And when you look at the loan sizes of $500,000 as a max, and it's houses, you might get a lot of people in London that say it's not going to impact us in any kind of way. But the reality is, it starts the market moving again globally. Not globally, obviously in the UK, it starts that market moving. It builds those chains, and it might encourage people to move into areas that they couldn't afford otherwise because that chain has started. So I think everything has a positivity behind it. You've always got to try, in my eyes, always try to find a positivity in something. I think innovation is something that we've really needed, and I think we could have gone a long way with this. But the battle of, people talking about negative equity in this, I think that's guarded by the 5-year fixed product, because property always performs over that kind of period. And if it doesn't, what's the comparison? You compare that negative equity against the cost of 5 years of rent. What's the cost of 5 years worth of rent in comparison to negative equity? What's going to be higher? There won't be much in it if there is negative equity. So it balances that out in my eyes by having a product that is structured over a 5-year period. And as Jeremy says, crucially, on a repayment as well. So repayment mortgage, overpay where you can. We've always said this, in a cost of living crisis, people need to learn to make sacrifices, make those sacrifices to overpay on that mortgage, and you'll build your equity quicker. So to me, it balances that out and gives everyone a good chance to build equity, get on the property ladder, and stop flushing their money down the drain in rent. Was that positive enough? That was fairly positive, wasn't it, I thought?
That was good, Lee.
Thanks, mate. Cheers. I do try to.
You're in the positive corner. You're always in the positive corner, Lee.
I do try to.
Always. You all are, actually, and that's what I love about this industry. Actually, we all love a moan and a groan, don't we? But actually, even in the hard times, and it is hard times for brokers and lenders alike, we're still trying to do our best for the clients and look at every positive that we can, really. So
I touched on this before, Mons. I was just going to say, in terms of first-time buyers, we've touched on this before. There's a certain lack of investors still buying, especially now with rates going up again. The margins for investors aren't there, so it's giving first-time buyers a clear path at property with smaller competition and more chance of getting the step on the ladder. So when you look at things like Helping Hand with Nationwide, with the 99% mortgage with Accord, with Skipton's offering 100%, they've got more innovation and more chance of getting on, and they've also got less competition than they've had before. So it's a perfect time for first-time buyers right now, in my eyes.
Yeah. And Avi, what's the view of first-time buyers? Are you starting to see a lot more wanting to come into the market? We've had all the the trust debacle and the scare that interest rates are going to rise through the roof. And Jeremy, that's a brilliant point around actually, base rate is there's sort of a cap on it now, isn't there? We all expect, and actually sometimes we forget that. But Avery, you see more first-time buyers express an interest in getting on the property ladder again? Yes,
I'd say a majority of my clients are first-time buyers. It just seems to be the demographic that I tend to attract through the marketing that I do. And to be honest, first-time buyers know no different. Yes, they may have heard about lower interest rates, but they've never experienced the lower interest rates. So actually, them coming into the market now, they're probably coming in at the best point, because if they can afford the higher rates, there's more of a chance that in a few years' time, they're going to experience slightly lower interest rates rather than the other way around. So for a lot of first-time buyers, the rates themselves are probably not that much of an issue. It's more so your affordability as a result of the higher rates that tends to be the problem. Especially when they are needing to kind of go to the top end of their budget because of property prices, because obviously they've gone a little bit crazy as well. So it's balancing all of those aspects out. But from a demand perspective, as I say, first-time buyers are probably the strongest buyer group at the moment.
So I'm just interested on the marketing point there. How are you marketing to first-time buyers? What's your
I've taken the stance of education. So I've got a TikTok channel that I kind of started off with, and that's primarily where I get majority of my business from, because that tends to attract all the first-time buyers. So I do a lot of educational style videos of, what do lenders like to see, what they don't like to see, explaining swap rates, what's happening with interest rates, giving people more of the kind of the know more before they even have a consultation with me. And then when we have a consultation, a lot of them will have seen a lot of my videos already. So they kind of understand what I'm talking about at that point already, but then they've got the opportunity to ask further questions. So yeah, it's kind of the video content that's been working really well for me.
Yeah. Nikki, what about you? First-time buyers a big part of your business?
Not necessarily a big part. I don't have a particular niche of clients. I've seen a lot more remortgage coming through lately. So for me, I've definitely seen a boost with regards to more inquiries from first-time buyers since the beginning of the year. I think we've left a lot of the negative of last year behind. So for whatever reason, whether it's marketing and the products that have become available, I've definitely seen an increase in interest. But I do personally have a variety of clients. I think, what Ava said is key there. It's the first-time buyers are generally this new generation, the younger generation. So it's tapping in on them, on your socials, because that's the first thing they're going to do. They don't know any different now. They're going to go straight onto social media to get advice or get educated. So I think staying on top of that as brokers is really important. I think I'm still speaking to parents that have got kids who they want to get rid of as well. But obviously it's very, very difficult. I still see, generally I do think it's hard. When I think back to my own youth, I feel like it was just what a lot of young people did in terms of getting out of home and buying their own house. I probably don't see that as much now, because I do think it's harder for first-time buyers in the sense of just where the levels of property prices are. You've got to have a pretty good income, or at least have a partner of some sort to buy with. I think it's very difficult when you're a sole applicant nowadays to get on the ladder, simply because you need a fairly good income as well as deposits. And obviously this is why these schemes are brilliant. But yes, I do deal with a variety, but I think there's lenders are bringing more and more forward to help those clients, so we can only keep embracing that.
And Rohit, from your perspective, do you think there's anything that's still missing for a first-time buyer? What more can the industry be doing to help first-time buyers?
I think it's a difficult one. I think it comes back just simply down to the deposit is the biggest thing at the moment with first-time buyers that we speak to. Is they don't tend to realise the level of deposit they need initially. They might have saved up, a reasonable amount, but but it's still not enough, particularly where we are in the South Coast along here and the property prices down here. It's just not quite enough as to there. So anything that can help ease that pressure, which is why the 99%, the 5,000 deposit mortgage was really welcome down here. That really helps. And I think things like offsetting some of the costs that they see when they initially make the purchase as well, if there's anything that we can do around that, and some of the cashback offers and more innovative green options, because we speak to a lot of first-time buyers who are concerned about their carbon footprint, and they talk to us about green mortgages because they've seen it, but when we actually generally dive into it, there's really little difference between a normal mortgage and a green mortgage.
Well, that whole green debate is something that's one on itself, really. We have done something on that, so that's interesting. That's going to run, especially if we do get a change of government. I think that's going to come straight back into the fore again. But one thing we were talking about actually just before this, which I thought was interesting, was this whole question of vulnerability, which I thought we should probably cover, because I'm really interested in this. Obviously, we're in a post-consumer duty world now, and everyone's waiting to see what the FCA questions are going to be in June, when we have to do our first reports around consumer duty and vulnerability. And especially when you have a product like this in mind, does vulnerability come to the fore a little bit more? And Jeremy, from your perspective, from a lender, I know as brokers, we sometimes, where I struggle is, how much do I need to tell the lender about someone who I think is vulnerable, what actually is, what makes someone vulnerable? Because if we look at where we are at the moment in a cost of living crisis, there are a hell of a lot of people who can be described as vulnerable. What's your take on it, and where do you want to be told of vulnerability, and does that have an effect? I guess that's a big broker question.
Yeah, so I think probably the best place to start is the lenders want to help. So vulnerability for us is, how do we help your customer with a better journey, or how do we make changes or make improvements for your customer so that we can help them not only now but during the course of that mortgage once it actually completes. So I think if we take away the concern that a lender sees vulnerability as, oh right, we'll have to change our lending decision, that's not why we're asking for this information. So think of vulnerability as the lender trying to help your customer, and if that helps you disclose more things, that will just help us provide service for that customer going forward. What is interesting is that when we compare our Yorkshire Building Society brand to our Accord brand, we identify, or we see, or we record more vulnerability with our YBS customers than we do with our Accord clients. And that's not because the clients are different. I think it's just how it's recorded, and the fact that we speak to those customers and have those questions and we record it. So what I would say to brokers is, look, just share with us. We do want to help. See it as a way of helping. And I think we don't ask it very well. Lenders say, is your customer vulnerable? And that frightens people to death. Because what's the implication of that? Nobody, if you ask a customer, are you vulnerable? The chances of them saying yes are slim. So it's what changes can we make? How could we change our processes? Are there things that we could do to make your journey better? And I think if it's approached from that point of view, we probably then identify and are able to help with more vulnerabilities and support customers. That's the way I'd phrase it.
Yeah, no, that's interesting. It'll be interesting for you to maybe share how your direct team, the YBS customers or advisors, actually define vulnerability and what they're asking to get that brokers maybe aren't. We definitely need a bit more help and assistance around that. Yeah. Is that Lee? Is that something you look at? How are you looking at that whole vulnerability side thing?
I mean, for us, I'm similar to yourself. Once we've been doing it for a while, a lot of our clients aren't getting younger; they're getting older. As they approach the maturity of their terms, you've got to start looking at all varieties of how they're going to be servicing these mortgages. A lot of them past age 68, 67, 68, state of retirement age, with lenders pushing out their mortgage terms to 75, some of them going to 80, some of them going to 85. That vulnerability does become a little bit more questionable when you're looking at the viability of the pensions and how they're going to service it as you push those terms out. We've just got to make sure that we're covering all those avenues off. We're looking at that serviceability beyond those ages. And I think that's probably what we're seeing as the most vulnerable element. You need that innovation of pushing those mortgages for the longer terms to help people's affordability of the mortgage. But my worry is with more people heading over to interest only as an option of being able to service their mortgage at the moment to get through the cost of living, and more people pushing their mortgage terms longer to try and get over that cost of living crisis, is making sure we're addressing those vulnerability issues, because they're the ones that could end up just staying on interest only until the mortgage needs to be called in. You're just kicking the can down the road in terms of a repayment of the mortgage there. And those ones that are saying they're going to retire at age 80 or at age 85, are they really going to retire at age 80 or 85, or are they just doing that to reduce the mortgage payments and kicking down the can down the road for that? So it's the reactions to what we're doing at the moment to cope with the cost of living crisis that I think is creating a bigger vulnerability we really need to focus on right now, and just make sure it's it's being looked at properly.
Ava, how are you dealing with it, coming to terms with the whole vulnerability?
I think vulnerability is such a broad topic, and when you really dive deeper into it, anything could make somebody vulnerable. So for me, dealing with a lot of first-time buyers, for example, a lot of my first-time buyers are actually vulnerable because they have no clue about mortgages. So my job is to obviously educate them as part of the process, make sure that they understand what the commitment that they're getting themselves into, borrowing hundreds of thousands of pounds for the foreseeable. It's massive. So it's guiding the clients in that respect and making sure that they are always in understanding of what's going on, pointing everything out. So, when sending out a mortgage illustration, for example, really explaining every single bit of it and, allowing them to really understand what they are signing up for, rather than just being like, well, here's the deal. Do you want to go for it? Yes or no? Really going in depth with all of that. So yeah, vulnerability for me is such a broad range of things, whether it's, has something happened to that client. When you're having that, conversation with them, a lot of them do open up, and a lot of them do say, maybe something's happened, a bereavement has happened recently in the family, or they need to move out because there's family conflict or whatever it may be. And issues like that could make somebody really vulnerable, because they could be feeling like they are being forced to move out rather than it being their choice. So we really have to be almost careful and just always make sure that the client's being looked after no matter what.
Yeah, I agree. Rohit?
The way I look at it is
you've
got nothing to lose by identifying client vulnerability and everything to gain from it. That's the way that I look at it. It's better you're not going to get, marked down from compliance or anyone else like that if you've accidentally marked someone down as vulnerable and they turn out not to be as vulnerable as you think they were. But we talk to clients who are in financial vulnerability, who have English as a second language, all sorts of different things. And it's better to note that down and then speak to a lender about those kind of circumstances up front and put that in place, because you're not going to miss out on anything by not doing it.
Nikki, you got any other views on this?
Yeah, I think as a broker, for me, it does put a lot of emphasis on the importance of recording those conversations. I think historically I probably would have said less information because you're always conscious of saying the wrong thing. But I think now I'm more about open, honesty, and just protecting yourself and the client in that respect. I think it's, for me now, I'd much rather put those conversations and record that so that we can sort of have that opportunity to check in with the client as well. I don't think brokers nowadays are there to just, do the first mortgage and then churn out the next rate switch product transfer. I think that is another great opportunity, especially with vulnerabilities, to check in with the client, keep contact with them, It's definitely a more personal touch. It gives us the opportunity to revisit them. You know, it's not just getting a new rate anymore. It's about, okay, budgeting, you know, how are you managing? What impact is that new increase going to have on your lifestyle, your family, your money? So I think it opens up such deeper conversations, which I think to do our job, we really need to encourage. But it also, for me as well, emphasises the importance of other things. So the other services that we can offer as brokers, protection particularly. Yes, you know, we're in a climate where cost of living's high, you know, it affects all of us. But that also emphasises other needs that they might not have considered in the past, but they now may be in a position where they do need other things like protection more than ever. So I think it's really, really, it's again a positive thing. I think we've got to embrace it. You know, we're encouraging people to be more vulnerable and have these open conversations. So I think we've got a big responsibility as brokers, because it's us that they come to and open up to a lot. We all know how, you know, that quick chat always turns into quite a long conversation. But that's part of the job that I love, because I think that's, you know, we're very lucky to have that, you know, opportunity to speak to people in that way that they may never speak to other people, or they won't be able to do that without.
Yeah.
So I'm all for it.
I think the irony is every client that's taken a mortgage in the last 5 years is probably vulnerable because of the payment shock they've all witnessed.
Yeah.
Yeah.
Probably goes back longer than that, actually, doesn't it? Last 6 years, every client has been vulnerable. Yeah. So maybe we should note down that all of them are vulnerable.
There you go. Right, look, 45 minutes just has gone very quickly. Always goes quickly. So I always do this. So actually, are there any final words of wisdom to both brokers or borrowers? Jeremy, you can have the first word. You just
better come off mute first. That's a good start. Yeah, always come off mute on Teams calls. That's a good start. Good tip for everybody. But no, I think we've mentioned it already. Advice at the moment is absolutely critical. The time for advice has never been more than now. You know, your jobs as advisors are harder than ever, but also probably more rewarding, because it's not just about what's the cheapest 5-year fix. Can you get one below 2% or not? There's some real individual conversations with customers where you will make a massive difference. And the launch of that 5k deposit just brings back humanity into a lot of this. We really have seen how there are the people at the end and make the stories. So think about the people, think about how you deal with them, and the value of advice is as big as it's ever been.
Love that. Rohit?
So I think you asked me earlier on about something more that can be done for first-time buyers, and I don't know why I didn't say it at that point, but I've just remembered it, so I'm going to say it now. Self-employed. We need better accessible affordability for self-employed, particularly when they have a good history of self-employed. And I think that's where we always struggle with people, first-time buyers who are self-employed. They're always kind of a bit worse off than people who are employed.
Good point. Good point. Well made. Lee?
I don't want to plug lenders. It feels a bit wrong to do it. But for me, because of the climate we're in at the moment, I think a nationwide solution of up to 6.5 times your income on a like-for-like remortgage should be something that's rolled out to more lenders. So more clients that are remortgaging the same balance and not raising debt have more of an option when it comes to the end of their mortgage. I think if Nationwide can do it, surely there's a reason that other lenders can come to the fore and do something similar, just so clients have got more choice when it comes to the end of their current fixed product. Preaching over.
There you go. Ooh, bit of a preach from Lee. It's interesting that I guess you've got some regulatory concerns there around the amount of business you can do over 4.5 times income, etc. But yeah, I would echo that, Lee. Anyway, Nikki, any last words of wisdom?
I think I'm just all about supporting each other. I don't think, we're not competing with each other anymore. I think it's good to share best practices, do things like this, and all work together, lenders, brokers, everyone in between. I think we've just got to encourage that, because we've all got to be reactive to an ever-changing market. I think normal will never be the same again. So I think we've just got to work together and support each other and adapt the new era that we're coming into. Definitely.
Love that. Ava, final words.
Always do the right thing and don't be afraid to say no. And learn about swap rates.
Mm-hmm.
And TikTok.
Lee's giving lessons. Yeah. And TikTok, yeah. Yeah. Jeremy, did you have you had one last thing? Go on.
Yeah, it was just
I'll let you.
Thank you. It's just a shout out to MPowered, actually, because there's very few lenders who would have invited another lender onto a webcast. So I just think, they've done this in the spirit of it's the right product and the right time. They do some great things, but they don't do this product. And I just think it's kudos to them for inviting another lender onto their podcast. So thank you.
Yeah, agree with that wholeheartedly. I think we should have more of that kind of stuff. So we are definitely out of time. Thank you to our guests, Ava, Jeremy, Lee, Rohit, and Nikki. We have started shouting out a Star Broker of the Week at the end of each webinar. So please tag MPowered on socials when you've seen a broker go above and beyond. And the shout out this week is Star Broker Elliot Beasley from Upperton Advice. Elliot exemplifies the essence of a star broker, supporting clients through challenging circumstances, ensuring they receive a transparent, tailored service, and ultimately delivering exceptional results to meet tight deadlines. Well done for your hard work and dedication, Elliot.
Well
and I know there are lots of you out there doing the same thing. Remember, we are now bi-weekly, so we don't have one of these next week, but we do the week after. You can listen to all of them on Spotify. I'm off to sing like a strangled cat. If you have enjoyed it, I've been Andrew Montlake. If you haven't enjoyed it, I've been Hamza Yusuf. Until next time, have a great week.
Thank you.